There are 3 ETFs that I'm never going to sell ever. And I'm going to share with you why you should never sell these, because they can help you secure your financial future in retirement. My goal in life is to live off of my brokerage account. So when I put money into these things, I want to make sure that it generates me enough income where I can live the life I want to live and keep reinvesting in the future. For you, your job, if you're saving for retirement, is to make sure that your money goes into tax-efficient accounts that can grow and compound for decades to come. So that way, when you're ready to retire, you have all the money you need. Now, even though our situations are different, our goals are the same. We want to be able to have enough to live the rest of our life and not worry about things. And that's why these 3 ETFs will be added to my portfolio. These 3 ETFs are SCHD, SPY, and QQQ. So what are they? SCHD is the Schwab dividend portfolio. It tries to mimic the Dow Jones 100 dividend portfolio. SPY, S&P 500. Very simple. And if you only do this one, you're probably going to do very well in life. But if you want to get some extra returns, I think you got to add QQQ into your portfolio. This is the Nasdaq 100, which is highly concentrated in high growth, high compounding companies like Adobe, Microsoft, NVIDIA, and that takes the guesswork out of what companies to pick that can grow for the future. Now, you guys know me. I have 18 individual companies and I want to have 30 or 40, but it's not mutually exclusive. I'm still going to add these to my portfolio along the way. Why? Because these do a good job of hedging myself and smoothing out my returns. So if some of my stocks are laggards for a while and these things are up a lot, boom. If some of my stocks are doing well because they're more value plays while these are down, boom. I'm hedging myself in a certain element. Now you might think, well, that's over diversification. Maybe, but my position in life actually is very similar to yours, because I want to live the rest of my life with my money, and you don't need to touch that money until you're 65. And then at that point, you'll live the rest of your life off that money. But the goal for you is to make sure you're putting it in tax-efficient accounts like your IRAs and your 401ks, so it can compound and compound and compound for decades to come. So let's break down these ETFs to see what's in them and why they're attractive to me. So this is SCHD. Again, this is the Schwab dividend portfolio. Expense ratio, look how low that is, 0.06. That means, let's break down the math. If you put $1,000 into this, 1% would be $10. 1% of 1% would be 10 cents. So this is 60 cents a year for every $1,000 you put in there. That's nothing. The average mutual fund charges around 1%, if not more. So this is going to compound on you for a long period of time. Next thing, people love dividends. 3.39% current dividend yield. And I argue the market's massively overpriced. So when the market falls, this dividend yield is going to go higher and higher and higher. All right. Turnover ratio, 28%. That means they keep their stocks on average about 4 years. Not bad. Total assets under management. This is a good size fund, $64 billion. A lot of money in here, a lot of net inflows right now. And my guess is as stocks fall, these are more reasonably priced stocks, giving a good dividend. My guess is this will not suffer the same outflows that QQQ or SPY might get. So it's a great place to get some dividend if that's what you want. And you can, in your tax-deferred accounts, this can grow your dividends and compound on itself and reinvest it at higher rates of return. Here are the top 25 holdings for SCHD. Home Depot, BlackRock, Cisco, Chevron, Lockheed Martin, Bristol Myers, Verizon, Pfizer, Tech. The point is, it's all companies you know. I would be surprised if any of these were gone in the next 10 years. So these are high quality businesses. Now, I'm not breaking down their balance sheets. I'm not breaking down their price to free cash flow. The point of an ETF is you dollar cost average. Markets are up, markets are down. It doesn't matter. You keep reinvesting. ETF number 2, SPY, follows the S&P 500. Very simply. Higher expense ratio, which surprises me, than SCHD. Lower dividend yield, which makes sense, especially in this recent market where the Magnificent Seven that don't pay much in dividends, if at all, are surging. Turnover ratio, 2%. That means once every 50 years, the thing turns over completely. $592 billion in assets under management, adding $40 billion. Now, guys, there's another S&P 500 ETF called VOO, VOO with Vanguard. The difference is expense ratio is 0.03. Now, it's lower, and I will believe in that. But again, every $1,000, we're talking about 60 cents difference It adds up. But again, for some reason, I'm just committed to SPY because I owned it in the past and I've always owned it. But Vanguard is a phenomenal company and I probably should switch to that. Now guys, here are the top 25 holdings for SPY, and they're gonna go in order of market cap. Apple, Nvidia, Microsoft, Amazon, Meta, Google, Broadcom, Berkshire, another Google. These are the same company, don't worry about that. Eli Lilly. Guys, the bottom line is these are companies that are great. These are large companies. They're gonna drive the markets. These are the top 25 holdings, and they probably make up 40 or 50% of the market value, if not more, of the S&P 500. These are ginormous businesses. Your goal, your benchmark, everyone's benchmark is SPY. So if you're always investing in SPY, always investing in SCHD, how do you beat the market? Well, here's how you do it. You add QQQ to it, but you got to add it at the right time. Now here's QQQ stats. Higher expense ratio, 0.2%. Dividend yield, nothing, 0.6%. Turnover ratio, 22%, similar to SCHD, and 300 billion in assets under management and inflows of 22 billion, which I think are a lot based on where the markets are. These are the high tech companies. This is gonna look very similar to SPY at the top. Apple, Nvidia, Microsoft, Broadcom, Meta, Amazon, Tesla, Costco. You might look at it going, Costco? Yeah, Costco, it fits its criteria. AMD, Netflix, Google, PepsiCo. There are some companies here that pay nice dividends. This is all about the Nasdaq 100. And some companies are in the Nasdaq, but aren't necessarily high tech. But most high tech companies are in the Nasdaq. And the reason QQQ can do so well, tech companies are able to generate much higher returns on capital than other companies. They don't have to invest as much to get high growth returns. You look at a company like Google, not much growth in there, but they can grow their earnings per share by big leaps and bounds, double digits per year, because of their ability to generate more and more returns on less and less money. That's how you generate a lot of wealth quickly. That's how you get the multi-baggers. So as I was saying, let me compare QQQ and SPY to show how you could outperform the market by buying QQQ at the right time. So this is how you can use QQQ to beat the market. Guys, this is a chart of QQQ's total return versus the S&P 500 from June 1st of 2003, which was basically the low after the markets had crashed for 3 straight years. Now, obviously, this is the low, and it's a massive beat. Now, remember, after COVID, big drops, and there's a huge surge in these tech companies. But again, even going back, they outperformed. Now, let's check how they did from the peak of the 2000 bubble, because there's a lot of interesting data here I really want you to see. This is essentially from the peak of 2000, March 31st of 2000. I think the peak was like March 20th or March 10th. Here's QQQ, here's the S&P 500. Again, the peak. But remember, look how much it fell. The Nasdaq fell 83% from its peak. The S&P fell about 50%. Big time difference. And it took a long time. It got close to even at COVID. But guys, this is huge. Now, you might look at this and go, well, Paul, I can't time the market. And it goes to show that I shouldn't be investing now because valuations are so high. Well, wait a second. What we discuss all the time is dollar cost averaging. Let me tell you this. I went back personally and I did the numbers from the peak of the 2000 bubble. So let's say you started investing literally at the absolute highest point and you absorbed that 83% fall. If you dollar cost averaged $200 per month in the S&P and QQQ, today, you know what your returns would be? Let me show you. Your QQQ return would be 13.5% annualized, while your S&P 500 would be 10.5%. And this is after watching an 80% fall. That's the power of dollar cost averaging and letting things compound. So you'd look so bad along the way, but as stocks fell, you'd be adding more and more money. And as they started to gain momentum, all that money that you added would keep growing and growing and growing. And look at this massive outperformance. So this is why I believe that you can beat the market using just ETFs. Basically just using 2 different ETFs, SPY and QQQ. And this is exactly why I'm going to include those as my 3 ETFs that I never want to sell. Now the last one, SCHD, I've made a video before, and I want to explain to you why I like SCHD. 1, less volatility. It tends to do better during bad times. Why? It's a dividend ETF. Tends to be more boring companies with less volatility, less hype. So when things fall, they're going to go down a lot less. When things are up, they're going to go up a lot less. Here's proof. From the start of SCHD back in 2011, it's the worst performer. QQQ is up 891%, S&P 500, 518, SCHD 415. But look, SCHD and SPY only started to shift apart really substantially back during this Mag 7 huge monster rally. Apart from that, they were pretty much in lockstep along the way. So it's a good way to get some dividends, less volatility, and grow your money. Now you got to keep in mind, my situation is different. If you watched our video about SCHD, I told everybody, guys, the reason SCHD works for me is I have 1,000 apartments upstairs and growing. We're going to have 5 or 10,000 units in the next 10 years. I've got 5 or 6 businesses upstairs, 2 or 3 of them which generate big revenue and good profit. Okay? I don't need my money to kill it for me, so I'm okay getting less returns. I'm okay being a little more conservative. And don't forget, I'm still buying stocks, individual companies that fall into my category that I really want to own at great prices. I can be pickier on my investments in individual companies as I have these ETFs in my portfolio. Now, in full disclosure, I don't own any of these ETFs yet. I'm trying to decide how I start dollar cost averaging, because that is my plan. I will dollar cost average into all 3 of these ETFs at a certain point and just start going month to month. History has shown that putting the lump sum in tends to do better, but for my psychology and the fact that I can still get 4.5% of my cash, I'm in no rush. So for me, I'm going to dollar cost average into these. And if stocks fall, there might be some individual companies I want to keep adding to, and that'll do really well for me over time. And on top of that, all 3 of these ETFs have a lot of volume and they're big. So I can sit there and generate extra income on my money by selling covered calls and cash secured puts in order to buy and to generate income along the way. That income can generate 1 to 3% extra per year. And a lot of our community members are doing way better than 1 to 3%. In fact, Mo and I tend to do a lot better than 1 to 3% since we've been doing this for the last 4 years. Now, guys, I did a further video on why I'm buying SCHD. So do me a favor, click on the card to watch that video. Thank you for your time.